Now, I want to switch gears just a little bit because for some of you, you've got rental property you've owned for years. You'd like to sell it because you want to get out of being in the landlord business, but you don't want to sell because there's too much taxable gain. Here's a strategy that might be fantastic for you. It's called a charitable remainder trust. And with a charitable remainder trust, here's how it works. You contribute the asset to the trust, first of all, and then the trust sells the asset, and because it's a charitable trust, it's tax exempt, it pays no tax. You receive an immediate tax deduction for a portion of that gift, usually 10% of the value of the property, and most importantly is you receive income and principal payments over your lifetime. And if you're married, it's over you and your spouse's lifetime. It's a great way to sell an asset, pay no current tax, have all of that asset working for you, and then you get a lifetime earnings stream to boot.
Right, if you take a look at it like this, let's say that you have $1 million property, right? So you got $1 million, and let's say you depreciate it down to nothing, so you have $1 million gain. Well, a lot of people don't want to sell that because it's like, okay, I got depreciation recapture, I got capital gains tax, I got the new net investment income tax, I got state tax. I might lose 40% of that, so now I'm only working with $600,000. I don't want to cut a $400,000 check to the IRS. Now, if I do this, I take this $1 million and I throw this into this charitable remainder trust. All right, what this is going to happen is now that charitable trust is going to kick me out an income stream. Okay, so you sell the property, the trust pays zero tax. It pays zero tax because it's a tax exempt entity. The $1 million property, boom, it's in the trust. They sell it, and all of a sudden you can work now on $1 million versus $600,000. Just think about how much more income that you can receive off of $1 million versus $600,000. It's simple math. Here's the caveat, is that now 10% of this asset will go to the charity. So you get 90% back in most cases if you live until life expectancy. So you can set these trusts up in multiple ways. I'm just using this as a very simple illustration. I have $1 million property, I don't want to pay tax on it. I throw it in this trust. It could be a tax exempt trust, a charitable remainder trust, whatever that you want to call it. Then the charity will get the remainder, which is usually 10%. So then you get the $900,000 back plus the growth as an income stream for the rest of your life. The charity gets their piece, and then here's another kicker to boot. Because I put $1 million property in here, I also get what? Look at this, $100,000 tax deduction that given year. I put $1 million in, I get an income stream, the charity gets theirs, plus I get a $100,000 tax deduction. This strategy works very well for a lot of different people. You just need to look at it to see what are the rules, how does it apply to my overall situation, because then you can take this tax deduction and start doing pretty cool things, Al.
Yeah, there's no question, Joe, and this is what we call a bet to live strategy. So,
yeah, you want to live, because if you die, right, let's say you put it in the next day and then you die, well then everything is going to go to the charity.
Yeah, and that's really a key point. So in other words, you put the asset in the trust whenever, if let's say you're married, when the two of you pass away at some point, one maybe first, one second, whatever's left in the trust at that time goes to charity. So if you only live another couple of years after you do that, then charity is going to get the majority of the asset, right? So on the other hand, if you live past life expectancy, charity may get a lot less than 10%. So that's how these things are set up generally. So if you think you have a long life expectancy or your spouse long life expectancy, this could be a real winner for you. Even if you're not that charitably inclined, Joe, we have lots of people that do this that say, wow, this is a good deal, and it feels good to give to charity, but really it's helping me a lot.
Right, I mean, like I said, if you plan a gift, right, the IRS is going to forgive that tax. And so this is a perfect example. You are giving it into this charitable trust. The charity is definitely going to get theirs. Now, another thing that you can look at is to say, man, I want to protect myself just in case if I die prematurely. Well, some people then set up another trust, a wealth replacement trust, and then they put maybe a second to die life insurance policy in there. Then that would go to the kids just in case you die prematurely.